Listen, if you looked at the normal 4-year cycle,
The 4-year cycle.
The 4-year cycle.
4-year cycle? Is it over?
There's a story that every Bitcoin investor knows by heart, and it goes something like this. Every 4 years, the halving arrives. Supply gets cut in half, scarcity kicks in, and the price explodes. Then it crashes, winter comes, and we all wait for the next cycle to begin. This narrative has become gospel, a calendar you can set your entire portfolio to. But I've been staring at these charts for a while now, and I'm starting to think we've been telling ourselves the wrong story. Because when you zoom out far enough, something strange starts to emerge. Every time Bitcoin crashes, something else is always happening in the background, something much bigger. The Fed is tightening monetary policy, liquidity is draining from the system, or the global money supply is contracting. And every time Bitcoin goes parabolic, you find the exact opposite. Money is flooding into the system from every direction. Once you see this pattern, you genuinely cannot unsee it. Bitcoin doesn't just correlate with global liquidity, it amplifies it, like a mirror that exaggerates every single move. So I started asking myself a very simple question. Has Bitcoin ever crashed into a prolonged bear market when global liquidity was actually expanding? Finding the answer took me through every major crash in Bitcoin's history. Let's start at the very beginning, back in 2011, when Bitcoin collapsed from $32 all the way down to $2. Most people write this off as growing pains, just a baby asset stumbling around and finding its legs. But here's what else was happening that same year. The Federal Reserve had just ended its quantitative easing program. America was tearing itself apart over the debt ceiling, and markets everywhere were in panic mode. The S&P 500 dropped 20% in a matter of weeks. So was Bitcoin really crashing on its own, or was it simply caught in a much larger tide? Now fast forward to 2014, when Bitcoin collapses again. This time, believers point to it as definitive proof that crypto moves to its own rhythm. After all, stocks were doing fine and the broader economy looked healthy. Bitcoin seemed to be falling all by itself. Except it wasn't really alone at all. Gox, the exchange that handled roughly 70% of all Bitcoin trading volume worldwide, had just imploded spectacularly. 850,000 coins vanished overnight. That's not a cycle playing out, that's a cardiac arrest. Bitcoin didn't need the global economy to contract because it had its own internal crisis creating the exact same effect. Then came 2018, and this one looks like the cleanest 4-year pattern of them all. Bitcoin peaked in late 2017, crashed throughout 2018, and then spent about a year in the wilderness. But when you pull back the curtain, the picture changes completely. The Fed raised interest rates 4 separate times that year, while quantitative tightening was actively sucking dollars out of the financial system. The S&P 500 posted its worst quarterly performance since the financial crisis. And inside the crypto world, the ICO bubble was imploding at the same time, with billions in paper wealth simply evaporating into thin air. You had external tightening and internal collapse happening simultaneously. Then 2020 arrives, the halving happens on schedule, and Bitcoin goes absolutely parabolic. True believers point to the cycle and feel completely vindicated. But let's remember what else happened in 2020. The largest coordinated money printing operation in human history. Central banks injected trillions of dollars into the system. Interest rates went to zero, and stimulus checks landed in practically every mailbox in America. The M2 money supply went vertical almost overnight, and everything with a price tag exploded. Stocks, real estate, art, meme coins, all of it. Bitcoin didn't rally because of the halving, it rallied because the entire world was drowning in liquidity, and it just happened to catch more of that wave than almost anything else. And then we get to 2022, the crash that genuinely broke people. By now, you can probably guess the backdrop. The Federal Reserve launched its most aggressive hiking cycle in over 40 years, while dollar liquidity drained from global markets at a record pace. And inside crypto, the dominoes started falling one after another. Terra, then Celsius, then Three Arrows Capital, and finally FTX. The same pattern repeated itself once again. External tightening combined with internal collapse, each amplifying the other. I went through every single crash, every winter, every so-called cycle in Bitcoin's history. And I could not find even one instance where Bitcoin collapsed into a prolonged bear market while liquidity was actually expanding, while money was flowing freely and financial conditions were loose. Every single time, it was the exact opposite. The 4-year cycle narrative isn't technically wrong. It just captured a shadow instead of the substance. The halvings happened to land right when the broader business cycle was turning, when liquidity was already shifting direction on its own. Bitcoin was simply responding to those larger forces. We thought we had discovered this profound internal pattern, but what we actually found was a coincidence that got dressed up as destiny. Now, none of this makes Bitcoin any weaker as an asset or an idea. If anything, the fact that it has survived 5 separate liquidity crises and emerged each time standing, that's precisely how an asset earns genuine credibility. But this realization does change how we should think about what comes next. Because Bitcoin doesn't actually orbit the halvings. It orbits global liquidity. And liquidity itself orbits the business cycle, just as it always has. The 4-year cycle was a compelling story, and it served us well for a while. It just wasn't the complete picture. Here's what I think the real story is. Bitcoin isn't immune to the forces that move global markets. It's actually the single most sensitive instrument we have for measuring them. And in a world where liquidity cycles are becoming more extreme, more volatile, and far less predictable than they used to be, that extraordinary sensitivity isn't a design flaw. It might actually be the entire point.